What's going on? Rap Valentine here, your favorite accountant. I promise you this video, and like always, I deliver. I'm a man of the people. You guys want to know more about tax, and I'm here to provide you what you need. So without further ado, let's figure out from a high level how exactly personal income tax works. If you think about it, it's just one giant formula that looks complicated because there is a bunch of steps you have to go through, some hoops you'll have to jump over or through hurdles you'll have to jump over. But when it's all said and done, it's just one big long formula. And the tragic thing about this is that school did decide to teach us about formulas, but they thought that the quadratic equation, the Pythagorean theorem, etc., was more important than teaching us this specific formula. But that's why I'm here. That's why I have a job, so that I can teach you guys these things. But the individual tax formula starts with gross income. And Section 61A of the Internal Revenue Code defines gross income as income from whatever source derived, meaning that unless we specifically tell you that it's not taxable, you have to include it on your return. So that means things like, obviously, W-2 wages, 1099 income, capital gains from the sale of assets, stocks, bonds, passive income like interest income, income from a real estate rental, etc. All these things are included in gross income unless the Internal Revenue Code specifically states that it's not included. So you'll add up all of your income for the year, for any particular year, and the IRS allows you to deduct certain deductions against your gross income called 4 AGI deductions. AGI is just an acronym standing for adjusted gross income, and we'll see later exactly what that means and how significant that is. But some of these AGI deductions are items like half of the self-employment tax, self-employment healthcare insurance. If you're self-employed and you pay for your own health insurance, it's allowable to be deducted for AGI. Contributions to certain retirement accounts. If you have a traditional IRA, for example, you're able to take those contributions as a deduction against your gross income for AGI. Student loan interest, that's a big thing because student loans have resumed. The payments on these student loans that were in deferment have resumed this year, or this year as in 2023. So a lot of y'all will begin to see that the interest from your student loans is now a deduction for AGI on your tax return. Education expenses up to $250. So if you're a teacher and you pay for supplies in your classroom, up to $250 of these expenses are deductible from your gross income for AGI. So you'll total a lot, or obviously you'll total all of your deductions for AGI, deduct them from your gross income, and you'll get a figure called your adjusted gross income. And your adjusted gross income is important because a lot of the credits that we'll see later are either qualified or disqualified by your adjusted gross income. But once you calculate your adjusted gross income, and I'll show you how all these figures work on a actual Form 1040, which is the individual form that you file every single year. I'll show you how these specific pieces of the individual tax formula line up on your Form 1040. But once you calculate your adjusted gross income, you'll also be able to deduct what is called the standard deduction or your itemized deductions. The IRS lets you take the greater of these two figures here. And these are sometimes called below the line deductions or from AGI deductions. Those two phrases are synonymous. But the standard deduction or the standardized deduction depends on your filing status every year. If you're single, the standard deduction is $13,850 for 2023. If you're married, filing jointly, the standard deduction is $27,700 for the year, so on and so forth. If you're married, filing separately, it's this amount. If you're filing head of household, it's this amount. And it's just a freebie that the IRS allows you to deduct. So if your adjusted gross income is, let's just say, $100,000 and you're single, you'll take the $100,000, reduce it by the $13,850, and you'll get your taxable income. Alternatively, if your itemized deductions are higher or greater than your standard deductions, then it'll benefit you obviously to take the itemized deductions. And what are the itemized deductions? These are things like taxes, sales tax, property tax, for example, charitable contributions. If you contribute to a charity or a church or um, any other not for profit organization, when you get those statements at the end of the year for your contributions, you're able to take that to your tax professional. He's able to calculate your itemized deductions using that statement. Some other very vital itemized deductions are things like medical expenses. So you'll tally all of these specific expenses up, and if those outweigh or are greater than your standard deductions for the year, depending on your filing status, it'll benefit you to take the itemized deductions. So just to recap, you have your gross income. So you'll tally all of your income for the year, take your 4 AGI or above the line deductions to calculate your adjusted gross income. Once you have your adjusted gross income, you'll be able to take from your adjusted gross income the greater of the standard deduction or your itemized deductions. So I hope you're with me. If not, rewind or drop a question in the comments. I'll be happy to answer. And once you get that figure, you're also able, if you're a business owner, if you have self-employment income, if you have income from an S corporation or a partnership, granted that that income is considered qualified business income, not the time or the place to discuss the qualified business income deduction, but just know that you're able to offset 20% of your qualified business income if you're a business owner um, as a deduction. So that figure gets you your taxable income. And this is the income that you're going to subject to tax rates. So once you get your taxable income, this is going to be the income, obviously, that's subject to tax. So now we have the tax rates. And how do we figure out the rate that your income is subject to? And this is a little bit of a TED talk, because one of the biggest misconceptions in tax is that individuals and their income are subject to a flat tax rate. You'll hear people say all the time, like, "Oh, I'm in the 24% tax bracket. I'm in the 12%. I'm in the 37%, etc." But that just means that the highest earned dollar of their income is subject to 37% tax, not their entire income earned. And again, so how do you calculate exactly how much tax you owe, or what tax rate are you multiplying your taxable income by? Again, you'll find very quickly in this industry that the simplest answer to all of your questions is that it depends. It depends on your filing status. It depends on how much wage you earn. Obviously, the more wage you earn, the higher tax rate your income will be subject to. But the tax rate is what's called progressive, or the amount of tax you owe progresses as the more income you make. So if you look here, if you're single and you earn up to $11,000, you'll only pay a 10% tax rate, or your income is only subject to a 10% tax. The next tier is how you should think about it. From 11,000 for a single taxpayer, from $11,001 to $44,725 is subject to a 12% tax. This does not mean that your entire earned income is subject to 12%. The first 11,000 is subject to 10. This next tier from 11,000 to 44,000 is subject to 12, and so on and so forth. So if you're a married filing jointly taxpayer, for example, and you make in between 190 and 364, your entire taxable income isn't subject to the 24% tax rate. Only that tier of income is. It's my TED Talk. So you'll subject your taxable income to this chart here. And again, this is for 2023. The tax rates and the tax tables and how much income is subject to what rate changes year by year, as well as the standard deduction. I don't think I mentioned that earlier. So this is for 2023 with changes if you're watching this in a future year going forward. This will be changed. So once you take your taxable income, subject it to this chart here, find out what your tax liability is. That's how you get your liability. Then you have to add to it like other taxes, for example, self-employment tax. If you're a self-employed individual, you pay the self-employment tax, which is essentially your obligation to pay Medicare and Social Security. There are other taxes you'll have to pay, like the net investment income tax, the additional Medicare tax if you make over 250,000 in 2023, et cetera, et cetera. So your income can also be subject to other taxes, which are then calculated on your return and added to your income tax liability. You get your total taxes. These tax credits are better than deductions because tax credits are a dollar for dollar reduction in your tax liability. Deductions, for example, for AGI deductions and from AGI deductions, just reduce the amount of income that's subject to the tax rates. Tax credits reduce your tax liability dollar for dollar. What are some of the most common tax credits that people take advantage of? Child tax credits. It's a $2,000 direct reduction of your income tax liability. Things like the American Opportunity Tax Credit for enrolled students in a qualified educational institution. They get a credit. And there's over 1,200 tax credits in the code. And this is how many people or many wealthy people take advantage of the amount of tax owed. They figure out how to qualify for these taxes and they take the required steps to make sure that they can qualify for these credits to offset them against liability. And then you have your tax prepayments. And most of the time, if you're just a W 2 wage earner, these are the amounts that are withheld from your paychecks. And your employer submits them to the IRS and to your state Department of Revenue on your behalf. So when you get paid a W 2, you're essentially filling out when you start your employment the W 4, and the W 4 allows or tells your employer exactly how much tax to withhold from you to submit to the IRS and to your state Department of Revenue on your behalf. You get a W 2 at the end of the year, and it reports that information, and you take that information to your tax professional, and he reports that as a prepayment on your return. So you have your income tax liability reduced by credits and also reduced by prepayments and withholdings. I have here that it's also reduced by estimated payments. If you're self-employed and you make quarterly estimated payments, your tax liability is also reduced by the amount of estimated payments that you make. And this is how you get your tax due or refund. So when you get your refund come year end, it simply means that you had more credits and more prepayments than your liability. If you have a balance due, it means that the balance is greater than the amount of credits that you qualified and the amount of prepayments that you made throughout the year. Short, sweet, not always so simple, but this is just a high level view of tax. Again, gross income, you take your 4 AGI deductions and you get your adjusted gross income. You get your adjusted gross income, you reduce that by deductions from AGI, which consists of the greater of the standard deduction or the itemized deduction, and also the deduction for qualified business income. That gets you your taxable income. You subject your taxable income to tax rates using this chart progressively in tiers to get your income tax liability. Sometimes you'll be qualified or you'll be subject to other taxes. You add those liabilities together to get your total taxes, reduce them by the amount of credits that you qualified for and the amount of prepayments that you make to get the amount due or the amount refunded to you. So let's take a look at a quick 1040 to see how you'll view this on your come year end on your return. So some of you should be familiar with this form. If not, you should be very familiar with it. Again, taxes are the biggest bill you'll ever pay in your life. So you want to understand what this is and what you're looking at and what this means. So this is just some general information that you'll always fill out. This just consists of your name, address, filing status here, your dependents listed, And then in this income section, it starts the individual tax formula. You have your income here, total amount from forms W-2. You have tip income. You have your qualified dividend income, ordinary dividend income, IRA distribution, Social Security benefits, etc. You have all of your income lumped into this bucket to get your total income amount here on line 9. Line 10 starts the adjustments to income, which you can find detailed on a schedule called the Schedule 1 of your return. And this Schedule 1 just details your 4 AGI deductions. And then you look at line 11 to get your adjusted gross income here. After you get your adjusted gross income, you're taking your standard deduction, again here on line 12, which your Form 1040 would spell out, or the greater itemized deduction if you qualify. You also get your qualified business income deduction, and then on line 15, you see that there's your taxable income. From the taxable income, the tax preparer or your software will automatically calculate the amount of tax owed. It'll run through this table for you, letting you know exactly what it is that you owe using calculations with the taxable income figure here in line 15. And once you get your tax due, you'll have some other taxes. If so, that'll be calculated, and then your tax liability is reduced by credits such as a child tax credit, earned income credits, etc. Then you also will reduce that by the amount of tax withheld from your W-2s or any 1099s that you receive. And the Form 1040 is going to tally all of that information up to see exactly how much you overpaid or how much you underpaid. And you'll get your refund or your bill come year end. And that's the tax formula. That's the individual tax formula. If you have any questions, again, just throw it down in the comments below. I'll be happy to assist you and happy to get more information over to you. But without further ado, let me know if you got any questions. Make sure to subscribe. If you support the channel, that'll be awesome. I appreciate it. If you got anything out of this video, if you learned anything, just give this video a thumbs up. And I'll see you next time.